Welcome! One of the kinds of problems that you often face in introductory financial accounting is looking at different financial statement accounts and needing to be able to classify them as to what type of account it is and also what kind of financial statement you would see that account on. And so you'll see here I have a list of accounts, and we're going to go through each of these accounts and we're going to label what account type it is. We're going to label them as assets, liabilities, owner's equity accounts, revenues, or expenses. And then we're going to note what financial statement those accounts would appear on. That's one of the fundamental skills that you need to get comfortable with in order to be able to do accounting, is to be able to take things and understand what they're representing, these account names, what are they representing, and then classify them according to what type of account it is and know where it's going to go on the financial statement. Okay, so let's start with accounts payable. Accounts payable represents amounts that the company owes to its suppliers, usually as payment for inventory that they have purchased from the suppliers. So they bought the inventory on credit and now they have to pay the supplier what they owe. The fact that this is something that they do owe means that it is a liability account. And if you've reached a point in your course where you have further classified assets and liabilities as current versus non-current, you may or may not be there yet. But if you're not there yet, you will be there. And the difference between a current liability and a non-current liability is how fast it has to be paid back. If it has to be paid back in less than a year, we call it a current liability. If it has to be paid back in, but not for more than a year, then it's what we call a long-term liability or a non-current liability. Accounts payable typically is going to be paid back within about 30 days, depending a little bit on what industry the company is in. So typically, though, it's going to be a current liability. And liabilities go on the balance sheet. Okay, accounts receivable, on the other hand, is kind of the flip side of accounts payable, only now it's the company that is owed money by somebody that it sold something to on credit. So rather than being the buyer of something on credit and owing for that, which was accounts payable, now we're taking the other side. So now we're the seller, the company is the seller, and they have sold to somebody else on credit, and now that customer owes them money. So accounts receivable is an asset. It's the right to receive the money that is owed as a result of the sale that was made. And like accounts receivable are typically current because they're usually due within about 30 days. Assets also go on the balance sheet. Buildings. The company owns buildings that it runs its operations in. Maybe it has a warehouse building, maybe it has an office building, maybe it has a storefront. Those buildings are assets. And because these assets are going to last typically longer than a year, we would call this a long-term asset. Or a non-current asset is another way to say it. And again, assets go on the balance sheet. Capital stock. What capital stock is it represents shares of stock that the company has sold to outsiders in exchange for cash. Those shares of stock represent ownership in the company. So when the company issued the shares of stock for cash, they now have additional owners in the company. And that's why we call capital stock owner's equity. It represents the claim that owners have against the assets of the company. And that is also part of our balance sheet equation. If you remember the equation for the balance sheet equals assets equals liabilities plus owner's equity. And so you can see so far our accounts have all been assets, liabilities, or owner's equity accounts, and that's why they're all on the balance sheet. That won't be true for our entire list, but the first few here happen to all be balance sheet accounts. Cash represents all of the cash that a company owns, whether it's stored in a bank account or whether it's cash on hand in a cash register. Could be checking account, savings account, money market funds, things like that. And that cash, of course, to the company is an asset. And again, that's going to be a balance sheet account. Equipment, maybe machinery, computers, the kinds of things that we use to make things in a manufacturing organization, that's an asset. And like the buildings, these are assets that we're using in our operations, and they're going to last longer than a year. And since it's going to last longer than a year, we call that a long-term or a non-current asset. And as with the buildings, equipment goes on the balance sheet. Interest expense. Interest expense represents the amount of money that a company incurs as an additional cost from borrowing money. So the company borrows money from the bank, and in turn they have to repay the amount they borrowed, plus they have to pay some interest. And so interest expense represents the amount that they have incurred on the debt that they had borrowed. That is an expense account, and expense accounts go on the income statement. Specifically, they reduce net income, so they're subtracted in the calculation of net income on the income statement. Now, interesting, here we've got interest payable. So interest expense, interest payable. Let's talk about what the difference between those two are, because oftentimes students will get those confused when they're first learning this stuff. The interest expense, as we said, represents the amount of cost that was incurred from borrowing money. The interest payable is how much of that interest hasn't yet been paid. So that's the amount of interest that's still owed by the company to whoever they borrowed the money from. So maybe they incurred a total of $2,000 in interest expense, but they've paid $1,800 of it. Well, then interest payable would only be $200. It's the amount that they haven't yet paid that they still owe. And since it's something that they owe, and again, whenever you see this word payable, it's a pretty good clue that this is a liability. And it is typically a current liability, although there are exceptions to that, but we'll typically use it as a current liability. And it does appear on the balance sheet in the liability section. Okay, inventory. Inventory represents products that a company has that they're going to sell. So they buy the products or they make the products and then they're going to sell them to customers. So when they're ready to sell, they're called inventory. That is an asset, something that has value. It's an economic resource that the company owns that will benefit them in a future time period. And inventory typically is going to turn around fairly quickly. There are some industries where it's an exception, but we won't deal with those this semester. And therefore, it is a current asset. And inventory does appear on a balance sheet. Land. If a company owns land that its buildings are on, or land that it's holding for investment purposes, or any kind of land that it owns, is an asset. It's an economic resource that will provide benefit to the company in the future. Therefore, it is an asset. Typically, it lasts longer than a year, and therefore, we're going to call that a non-current or a long-term asset. And that is going to go on the company balance sheet. Notes payable. Again, that word payable, when you see that, you go, oh, it's something that they owe to somebody. It's a debt. And that's another word for saying it is a liability. In this case, when it's called notes payable, the word notes comes from the fact that there is a promissory note underneath that notes payable. So the company owes money because it agreed to pay it by signing a promissory note that has specific terms, like how much interest is going to be incurred, what interest rate, how often payments need to be made, and things like that. So notes payable is a very formal type of liability. It can be current or non-current, depending on the terms of the note. And so I'll put that it could be current or not, non-current. Either way, it's going to go on the balance sheet in the liabilities section. Prepaid insurance. What prepaid insurance is the company having made a payment for insurance before the policy of the insurance actually takes place. So if the company pays for 18 months worth of insurance on January 1st, that is an asset to them that they have this policy that's going to last 18 months. And so when they first buy that policy, they're going to set it up as an asset account called prepaid insurance. And then as the time expires, as they use up that policy, whether they ever have to make a claim against it or not, as time expires, the policy will lose its value to the company, and therefore we will take part of that asset away and say that part's expired, and so we'll turn it into an expense. But while the policy is still in force, while the portion of the policy that hasn't been used up yet, that is considered an asset to the company if they've already paid for it, called prepaid insurance. And so that's going to be an asset. And typically it's listed with our current assets, although it depends a little bit on the policy and how long the policy lasts. Either way, it's going to go on the balance sheet. Prepaid rent is a similar type of account. When we have a period of time that we have paid for our rent, the right to use a building or whatever else it is that we're renting, what we've paid for that hasn't expired yet is an asset to us. So for example, if we pay a year's rent in advance, then when we first pay it, that's an asset to us. As we occupy that space or use whatever it is that we've rented, as the time expires that we have purchased that right to use that asset for, then it will become an expense. But when we first pay for that prepaid rent, that is an asset. And again, typically prepaids are within a year, but they don't have to be. Sometimes they will be long-term, but most of the time we will see them as current assets. And again, that will go on the balance sheet. Next we see rent expense. So the difference between prepaid rent and rent expense is rent expense is going to represent the time period that we have used for whatever it is that we have purchased the right to use, but we don't own it. So for example, if you pay rent on an apartment, and when you rent that apartment, you don't own the apartment, you're just paying for the right to use and occupy that apartment. When you first pay the rent, if you pay it in advance, it's prepaid. But then once the time goes by and you've used that space for the time agreed on, then that portion becomes rent expense. That is therefore an expense account, and it appears on an income statement. And then supplies. Supplies, when we first buy them, are an asset. They have benefit for us in the future. They're an economic resource. Typically, what makes a supply as opposed to equipment is that it's going to be used up within a year. So supplies are things like markers and staplers and paper and things like that. Whereas equipment is things like computers and buildings and land and vehicles and things like that. So the supplies is a current asset, which means it goes on the balance sheet. Okay, now we didn't cover every potential type of account that there is here. We only did a representative sample. There are things like sales revenue, that's a revenue account that goes on the income statement. There are things like vehicles that are assets that also go on the balance sheet. You'll see lots of different examples of accounts as you go through the course in Introductory Financial Accounting. You can look at example financial statements. If you come across an account that you don't recognize and that you don't know what it is, look for examples of where it's used. If it's an asset, a liability, or an owner's equity account, you'll find it on a balance sheet. If it's an income statement account, if it's a revenue or an expense, you'll find it on that income statement. If it's a dividend, then you'll find it on the statement of retained earnings. We didn't talk about dividends here. Dividends represents the company paying something back to its owners. So the stockholders that have made an investment in the company, if the company has made extra profit and they're not needing to reinvest it in the company to help the company grow, then they might give the owners back a return on their investment. And those are called dividends. Dividends are not on the income statement. They are not an expense. Rather, dividends represent a distribution of net income. They're not part of the calculation of net income, but it's what you do after you've calculated the net income. If you decide you've got enough left over, then you can give some of it back to the owners in the form of dividends. And so the only financial statement dividends would appear on is the statement of changes in retained earnings, or the expanded version of that that's sometimes called the statement of changes in owner's equity. All right, so this is just one example of the types of problems you need to be comfortable doing in introductory financial accounting. Thank you for your attention and have a great day.